Hi, Louis Llanes here. You know, a lot of people talk about how growth investing is such a great way to invest, and a lot of people compare value versus growth. And one of the things I wanted to show you is some kind of just recent data, and also looking at historical data going back further and looking at the different styles, the two main styles that people talk about, value and growth. And you know, it's really valid to look at value and growth the more I think about it, because the two largest, most effective factors in the marketplace that have the most robust ability to potentially generate alpha or excess returns is a value approach, which is looking at like multiples of the EBITDA, or earnings before interest and taxes, depreciation, and comparing that to price, or you know, there's many different metrics for value. Or for example, in growth, you could look at momentum, and those two factors tend to have meaningful abilities to generate alpha over a long period of time. But it doesn't seem to happen all at once. And one of the things that you get is you get these people or investors that have this dogma style of investing, growth or value. And I kind of want to make the case today that a holistic investor probably shouldn't do that. They should probably go and look at the factors for both of those and have some elements of both of those at different times, or even just have an overall approach where they're blending those two elements. So I want to just first off take a look at the last 10 years. So what this chart shows is the Russell 1000 Growth Total Return Index versus the Russell 1000 Value Total Return Index over the last 10 years. It's important to note that Russell style indexes are a pretty good benchmark to use, primarily because many of the asset managers use this as their benchmark. According to Russell, $35 trillion of assets under management are used, our assets under management are benchmarked to their indexes. So that's about 98% of the institutional money management that's done in a style-oriented fashion. So I think it's a good thing to start off with. Now, they have an interesting methodology. I believe they've actually changed the methodology over time. But if you look at the methodology that they use now, it's a couple of different ways of looking at it. For value, there's a book to price, or a book value relative to the price. And then on the growth side, they have a couple of different factors. They look at a IBIS, a forecasted earnings growth number. That's from IBIS. And then they also look at a 5-year historical growth rate on sales per share. So they blend those in a way to get an idea of, hey, these are the baskets of stocks that are growth oriented, and these are the baskets of stock that are value oriented. So if we take a look at this index, getting to the chart here, if you look at the last 10 years, what you see is the purple line, or the bluish line, is the growth total return index. And then the other line, which is kind of a yellowish line, that line is the value index. And what you see is that you see a vast, huge gap. You see a large increase in the growth index over the value index. And so if you were a money manager and if you didn't have some element of growth to your style, you are likely underperforming pretty dramatically. And one of the things that's interesting is if you're just an indexer, you're going to have kind of a shift in the weights, you could overlay the actual benchmark, the total Russell 1000, and look at that. You can kind of see the shifts. But just looking at these two styles, many investors over the last 10 years have just making the assumption that they're better off just buying growth style funds. And we see that a lot where we're looking at the 401ks, we're looking at people's investments, and we evaluate people's total portfolios. And what we see is people just throw money into these growth portfolios. The last time I remember seeing this was during the dot-com bubble. We saw this kind of behavior. And value really has not done so well. If you look at the recent data here, you can see that the growth index is near the highs already, or even surpassing the highs after this V bottom here that we saw from the pandemic. And the value stocks have rebounded, but they didn't rebound very, very strongly all the way to the highs. And that's indicative of concern that of value orientation. We really want to see a stronger economy for many of these value stocks to do well. And when you have a situation where growth is deemed to be scarce, the growth stocks tend to be bid up. So growth starts to outperform value. That's kind of the theory, anyhow, and you do see that in practice as well. But I want to go and look at history before that. If we look at the period from January 1970, so January 1, 1979. Okay, if we go from that period all the way up to August of 2007, August 1, 2007, we see a very different picture. Now, this is really my career. My career started in this area. And what you see is you saw value doing better. That's the yellow line, right? Value is outperforming. And I remember clearly when this happened, when we see this crossover right here, during the dot-com bubble, we saw a massive increase in growth outperformance. And that growth outperformance went way beyond levels all the way up into the peak in March of 2000. And so we saw that same kind of a run-up. But prior to that, we had value kind of outperforming. So most people were like value-oriented, and they wanted to stick with that discipline. And what happened was the growth stocks sold off, and then we had value take off, right? And it took a long time for the growth stocks to actually hit new highs. I mean, you could see through this period that the growth stocks were still well off their highs. And after that dot-com bubble popped, then we were way ahead of ourselves. Now many of these companies that were starting to come into existence during that time are big blue chips, and they represent kind of the FANG stocks or not necessarily the FANG stocks, but more of the stocks that are oriented towards the everyday technology, oriented index. So you have these morphs that happen over time. And so what we're seeing, my main point is that it doesn't make sense for you to say, well, I'm a value investor, I'm a growth investor. To me, it makes sense to have elements of both types of thinking in your mind. Right now, we are in a growth phase. One thing that's for sure is the relative performance, the relative strength, and the technical analysis will show you what is working, whether it be value or growth. So that's one of the other reasons why I like to look at the technicals as well, because as I always say that, you generally don't make any money unless the marketplace recognizes whatever opportunity you see. If it's a value opportunity and the market doesn't recognize it, you don't make any money. If it's a growth opportunity and the market doesn't recognize it, you don't make any money or you lose money. So the key is that you have to have recognition in the marketplace. A friend of mine also likes to say that only price pays. I kind of fought him on that, but I see where he's coming from on this. What he's saying is not necessarily that only price is the thing you should look at, but what he's basically saying is ultimately the price has to move in your favor in order for you to make money. So styles do move in and out of favor, and it's important that you understand that, or for investors to understand that if they want to have more of an all-weather approach. So as I've been thinking about style more and more, it really is important to have both a value and a growth approach if you're going to be active in your money management style. And what's interesting is I ran some data going back to, I believe, 1926, looking at small and large. And it's interesting, if you look at the Sharpe ratio, if you just take monthly return data, and you look at the reward risk, the kind of the average return compared to the standard deviation on monthly data, and you just compare different allocations to large and small, it's very interesting. You maximize the Sharpe ratio with a relatively small amount of small caps in there, going way back in history. There's times when small caps do better than large caps as well. But again, if you have a approach that is looking at the overall characteristics of each individual stock and you're going bottom up, I believe that you have a better Sharpe ratio over the long run, and that does back test to show that as well. And in real time, we see that with portfolios when you're volatility sizing and you're adjusting for correlations and understanding the underlying correlation drivers of the businesses as well underneath them, and you're blending that together in a way that's rational based on factors that are shown to have a higher propensity to generate alpha then you have a good chance of having reasonable returns, because what we're shooting for, we're not shooting for these massive runs like that. We're really not, our clients are shooting for more steady types of returns. So that's what we try to do. We try to have a methodology that is based more on stability and risk control with opportunity for growth, rather than to try to shoot the lights out. Because when you do try to shoot the lights out, you have to be extremely quick on your exits to try to do that. And actually, in the individual portfolios, it requires higher turnover, and it also requires a lot of small losses to be taken. And many investors do not have the wherewithal mentally to see lots of small losses and then that big gain, and lots of small losses and that big gain, more of a trend following type of an approach. We do follow that, but we do tend to see that kind of return payoff where we have a lot of more small losses, and then less big gains, and that those big gains way offset the small losses over time. But it's not so extreme. If you're really trying to have the best reward risk ratio, you have to be extremely nimble. And in an institutional setting, and for many investors, they just don't have the stomach for that kind of a turnover. So added diversification with other asset classes as well, combined with having a little bit longer term time horizon, really makes sense. And really being more style neutral, understanding that we have both elements. Like in our equity growth or equity income portfolio, there's more of a quality and a value tilt to that. In our dynamic growth, there's more of a growth and a relative strength tilt to that. And these factors are shown to add value to portfolios. And so, we don't necessarily want to get pigeonholed into one style, because style boxes can really hurt you if you're just saying, I'm going to, adamantly be in this style. Now, we have the luxury for working with private clients, high net worth private clients, and even millennial clients that are starting to grow their wealth. We've developed a service for those investors so that we can work with smaller account sizes and get people participating and plowing money away for their future, because the millennials really need help with this growth aspect as well. We want to be able to be style neutral. And we also don't want to necessarily just be a slave to indexing it as well. So anyhow, just some thoughts. I was sitting here. I'm actually technically on vacation, but I'm always doing stuff because my job is my hobby. But as I was here, again, we're here in Marco Island, and we're just enjoying the beach and stuff. But I was thinking about the growth and value aspect today, and I pulled up this history, and it just was a reminder, that you don't necessarily want to be a pigeonhole type investor. If you are, there's no problem with that, and you can do well in any camp. But for us, with our style, we're really looking for more smooth returns. We don't want to be stuck in an environment where we're going for 5-10 years where we're stuck with underperformance. No, sir, we don't want to do that. We want to avoid that as best we can. Anyhow, Louis Llanes with WealthNet Investments signing off. Hope you guys are having a great day. Talk to you later.